Great. Good morning, Your Majesty. We appreciate you coming, spending time with us today. I look forward to your remarks. Welcome to Madrid. What a great city. I want to echo Douglas's comments about our thanks to our co-sponsors, anchor sponsors, BBVA and Santander, Francisco Gonzalez, Ana Botín, who are on my board. Great board members. We spent several hours together yesterday. They keep me honest. They're great bankers, great institutions, world-class institutions, and we thank them for all their support, not only for this particular meeting, but in all our events, no matter where we are. We also have a number of other sponsors. Credit Suisse, Urs Rohner is here. He's also on my board. Abu Dhabi Global Markets, Banco Sabadell, SCB, Marcus Wallenberger is on my board as well. Swiss Re, Walter Kielholz is here somewhere, and IBM. And then we have a whole host of board members here today. Ralph Hammers from ING, John Cryan, Deutsche Bank, Steve Kandarian from MetLife, Axel Weber from UBS, and a long, long list. I have the best board around, let me tell you. We also have a number of very special guests here today from the Basel Committee, from IOSCO, from the ECB, from the Single Supervisory Mechanism, Single Resolution Board, about a dozen different central banks, and then some of our sister trade organizations from other jurisdictions. And of course, we have His Majesty the King, which I'll introduce in just a moment. If you've looked at the agenda, it's a broad array of issues, which I think reflects the work that the IF does. We have issues on global capital flows, cross-border resolution, blockchain and artificial intelligence technologies, risk sensitivity in the balance sheet, credit and op risk, European monetary policy, regional outlooks, including U.S. politics, which are very interesting right now. We're excited to be here in Spain, not only for the extraordinary weather, food, wine, architecture, fountains, culture, and people. As George Orwell said, the best place to be is strangers in Spain because the culture is so warm and the people are so forthcoming, and great and deep and wonderful history. But we're here because Spain is a good news story on the economy. It's one of the Eurozone's top performers. GDP growth in the first quarter was a sturdy 3.2%, faster than the US, France, Germany, Italy, Switzerland, or the UK. So congratulations, you're doing something right here in Spain. We're also here because of our Spanish members, really truly outstanding world-class financial institutions, which I've mentioned here today. They are profitable, they have strong balance sheets, they're world leaders in technology, and we're fortunate to have them not only as members of the IF, but as a part of the financial system. Let me quickly touch on two issues before we turn to His Majesty. The first is on regulation, which is really the tip of the spear of what we do at the IF. In the 8 years since the financial crisis, the financial industry has gone through an enormous historic metamorphosis. We've had a surge in additional capital. The largest global banks have raised over $1 trillion worth of Tier 1 equity capital. Capital ratios have jumped. We have more liquidity, less leverage a fraction of what it was in 2006 and 2007. We have resolution roadmaps. The FDIC head, Marty Gruenberg, was in Amsterdam a few weeks ago at the Eurofin meeting, and I was in the audience. And Marty said, in my view, and the quote, "We are at a point today that if a systemically important financial institution in the United States were to experience severe distress, it would be resolved in an orderly way." I think that's a great endorsement of the process. We have the introduction of TLAC, which Mark Carney called the essential element of ending too big to fail. We have more robust risk management practices, bone-jarring stress tests of our balance sheets, ring fencing, Volcker. We have increased focus on internal culture and governance, and comp systems which have multi-year clawbacks. The system is radically, dramatically different than it was a decade ago. However, the regulatory process remains. Some refer to the additional regulatory efforts in the pipeline as Basel IV. I know my friends in the audience from the official sector really dislike that term, so I'm going to be diplomatic today and refer to it as Basel III version 2.0. And the new approaches to credit risk, operational risk, interest rate risk in the banking book, and market risk. The introduction of new capital floors within the IRB and RWA framework, leverage ratio calibrations, and the finalization of the TLAC cross-holding requirements. These proposals, in combination, will likely force banks to raise significantly more capital on top of the trillion that's already been raised. And when we say significantly more, potentially 40 or 50% more. Now, the official sector is going to push back and say, show us your data. We're in the process of gathering the data. But the idea that somehow this is just affecting a few institutions at the extremes of the distribution curve, I think, are misfounded. The banking system will be forced to raise substantial levels of capital on top of whatever has been raised. And it's not only going to hit complex financial products like derivatives, which are used to, you can amplify risk, but it's also used to hedge risk, but will hit bread and butter banking products, mortgages, SME lending, corporate lending, and trade finance, the lifeblood of any economy, and certainly the economy of Europe. But the regulatory agenda doesn't end there. Our friends in the insurance industry are also facing scrutiny. We'll have an insurance panel later this morning. We'll hear from Tom DeSwan and Steve Kandarian from MetLife. Steve is courageously taking on the regulatory community in Washington with respect to the role of systemic designation, and we look forward to hearing Steve's perspective. And then on the asset management side, we're currently facilitating conversations with the FSB and IOSCO regarding their work on systemic designations as well, with respect to such things as liquidity mismatches, mass redemptions, leverage, and security lending. So it also reflects the broad array of financial intermediaries which are part of the IF family. But you have to judge all these regulatory changes against a very challenging backdrop. Global uncertainty such as Brexit, the US elections, the candidate, the presumed nominee, Donald Trump, has said just last week that he would repeal Dodd-Frank, but it's not clear what he would replace Dodd-Frank with. So enormous uncertainty with respect to financial outlook just in the US. Negative interest rates, flat yield curves, quantitative easing. All of these things have real impacts on our industry and on the macroeconomy, therefore on jobs. Robust economic growth in Europe depends on profitable banks earning their cost of capital and that are expected and allowed to take risks, extend credit, and provide critical business services. Earning your cost of capital is one of the basic arithmetic of banking. If your cost of capital is 12% and you're earning 4%, you don't stay in business very long. We must have a profitable banking system in Europe if we want European growth, European job creation, and European expansion. The second area I want to touch on is the role of technology in financial services, which has become a very important part of the suite of services and products that we provide at the IF. As many of you are aware, a few years ago, we started monitoring some of the great trends that are occurring and some that Francisco Gonzalez and Ana Botín at Santander have been at the forefront of, including Ralph Hammers at ING and other of our member firms. Digitization, data and data science, cloud computing, mobility, blockchain, artificial intelligence, and machine learning, and how all of these technological changes are impacting financial intermediation and delivery of financial services. There are challenges. We have new entrants that pose competitive threats in some segments. We have established institutions which are scrambling to upgrade legacy systems at enormous cost. And firms must remain hypervigilant against cyber threats, which are an ongoing 24/7 challenge. But new technologies also bring tremendous opportunities. Reach new customers in new ways, reduce transaction costs or clearing times, and leveraging big data to serve clients in new and different ways. Again, our Spanish firms and our IF member firms are world leaders. More specifically, the IF, we have included technology as a part of every one of our events. You just look at the agenda over the next 2 days. It's a central part of what we're doing. We have been visiting technology corridors in Silicon Valley. I'll be back out on the West Coast in 3 weeks, in London, in Singapore, all the areas that define themselves as technology corridors. We're there and meeting with innovators and officials. We're spending a lot of time with the official sector. There's a real scrambling that's going on in central banks and finance ministries and other regulatory bodies to understand how this changing technology is impacting how they regulate and how the market is developing. We did a blockchain event in Washington, D.C. during the IMF World Bank spring meetings where we had a number of central bank officials in to better understand what this new technology means for both banking but also for the regulatory side. We've launched a FinTech working committee with over 30 firms, and we've launched a RegTech working group to look at how technology can help with compliance costs. Just yesterday, BBVA hosted an innovation lab at their offices just down the road, and we brought in a number of innovative firms that are using technology which allows our firms to do a better job at compliance at a fraction of the cost. And we want to take cost out of the system. Technology and innovation will be a driving force in the industry for years to come. And we at the IF will focus not only on what it means for our industry, but what it means more broadly in the macro economy. How we work, how we save, how we create jobs, how we think about and measure economic activity. And what does the macro economy look like going forward? You know, technology, robotics, automation is fearful for many. In 1931, Albert Einstein gave a speech in Berlin in which he said, "Machines are the cause of joblessness in Europe." Machines are the cause of joblessness, 1931. Just a few weeks ago, the UK Telegraph ran a front page story that said, "Robots will take over most jobs in 30 years." So the themes of automation and robotics and technology, its disruptive, displacing force, is not new to this generation. It's been going on for years and will continue to go on. How we adopt and adapt to it, it will be one of the great challenges we face as policymakers, but as leaders in the business community. So I want to thank all of you for coming here today. We're just getting started. As Don Quixote said, "Thou hast seen nothing yet." So we have a full 2 days. But with that, it's my great honor and pleasure to introduce to you today our very, very special guest. Joining us this morning, His Majesty King Philippe VI, and he's going to offer some thoughts. Your Majesty, we appreciate you coming. Please come to the stage. Thank you very much.